Hello, hello, it's Yokai Kajidori here, and I'm very excited about module number 3 of income and cash flow statement. Super excited about what we are going to learn today, because I had a preview of what Daniel is going to be covering, and then we had, which I'm sure by now you've covered. This sets you up to understand the whole subject of income statement, financial, director in your company. So, welcome a friend of mine, a business partner, Daniel Feynman. Daniel, welcome again to the third module.
Well, thank you very much, Yukai. I'm excited to continue these. It's a lot of fun.
Incredible. And thank you for the session that you did previously. Outstanding work right there. Very simple. You took those complicated, broke them down into chunks that we can understand.
Well, I think that's why we designed it this way, to make it a little more digestible, to use a term, a little easier to take something as complex as finance and accounting. And if we break it down into its basic elements and take one step at a time, it becomes much easier to understand, be comfortable with, and eventually use.
Absolutely, absolutely. That brings me to the question that I know one had in mind, that, okay, suppose going through module 1 and module difficulties, what is the mindset they need to bring to this third module?
What I would suggest is they keep in mind that this is a new science being learned, and whether we're talking about paleontology or chemistry or accounting or finance, if we're not familiar with the terminology, if we haven't used the tools before, if we don't understand the sequence, it could be overwhelming, but it doesn't need to be. If we keep in mind that accounting is very logical, as is finance, and it's very sequential. If we take the modules and each segment in each module, one step at a time, we can walk through it and get a basic understanding. That would be the first phase, I would say. Absolutely. The second element is to use some of the terminology, use the tools. What we're going to start to share with our audience in this module is an Excel spreadsheet, and we will have several Excel models that we'll share with our audience as we go through the various modules. And they're set up so all you have to do is change the inputs. All of the formulas and functions are already set. So all anybody has to do is change the inputs, and they'll see automatically the outputs, the results change. That's probably one of the better ways to get comfortable with a lot of this. Use the tools.
Absolutely. You know, everything possible for you to make this for you to use. And again, should you have any questions, there will be a Facebook group and a side group that you can send messages. Both myself and Daniel will be in of the questions you may have, and we also have a support for you to respond. Get this, we want you to succeed because we know when you succeed, you're going to run your business better. You're going to be to your community and right where you are. With that said, Daniel, let's bring on the show.
Okay, Yukai. Well, to everyone, welcome back. If you remember, in Module 1, we started with the basic accounting. We started with our foundation, and we talked about cash versus accrual, market versus book, profits versus cash flow, GAAP versus IFRS. And once we established the real foundation here of accounting, we moved on to Module 2, and we started with the balance sheet. And please remember, there is no particular order in which the financial statements need to be presented. We just happen to start with the balance sheet. One of the keys to being comfortable with financial statements is to remember the number 3. There are 3 financial statements: balance sheet, income statement, and cash flow statement. And each of those 3 have 3 major components. If you remember, on the balance sheet, it was assets, liabilities, and equity. And we went through these and showed how they were linked. Well, today we're going to start with the income statement in Module 3, and we're going to talk about what the income statement actually is made up of and why we have it. The income statement is more like a movie. If we're comparing it back to the balance sheet, that was more like a photograph. The income statement, which is also called the profit and loss or the P&L, shows all of the activity, meaning all of our sales or revenue, and all of the related expenses or costs from a beginning date to an ending date. So if you're looking at an income statement, right at the top, in addition to the name of the organization, it should have a date that indicates from period A to period B. For example, from 1 January to 31 December. That would be a very common way to present this for a year. But income statements are also presented for quarters, particularly if an organization has a governmental responsibility or is a listed company or a public company. And many organizations produce, at least internally, a monthly income statement. And there's nothing magic about that, except it's very common. A lot of times organizations look at themselves on a monthly, quarterly, and annual basis. And part of what we're trying to do is judge, did we sell everything that we thought we would? Were all the expenses that we budgeted exactly what incurred? So that's why the income statement is one of the most important tools we can use. So let's look at the basic components that we have in your typical profit and loss. And please remember, accounting gives us the minimum requirements in a profit and loss, but not the actual line item detail. So the example we have here, your own profit and loss, or any other organization you may be looking at, there are going to be some differences in the number of line items, in the detail. That's all the art side of accounting. That is not the science side. That is the flexibility that you have as a user and creator of financials. How much information do you want to share, and how much information do you feel you need to share, both internally and externally? So let's take a look at this generic profit and loss. It always starts with what's referred to as the top line, which is your revenue or sales. Here's another one of those situations where in accounting, we have multiple terms meaning the same thing. Revenue or sales are used interchangeably. If we're a product-based company, then the next line will be cost of goods sold. That refers to what were the direct costs to create what we're selling. You'll notice to the right, cost of sales is a very similar term if we're dealing with a service-based company. Same concept. What did it cost us to directly create what we're providing, what we're selling? So if we take our revenue minus our cost of goods or cost of sales, that will equal our gross profit. Please do not confuse gross profit with real profit. It's one of those unusual situations where accounting uses the term profit in several different ways. You will notice here as we go through, we'll use it 3 or 4 different times. There are different versions of what accounting refers to as profit that are not really your net income, your net profit. We'll talk about that at the end. So gross profit is just representing the difference between what we have sold and the direct cost to create those sales. It's an important measure of how successfully we're creating what we're selling at a margin. So later we'll look at some ratios where we'll take the gross profit divided by the revenue to come up with a percentage, and then we can see if that compares to our budget, if that compares well to our peer group, if that's consistent with what we expected that margin to be. So revenues minus cost of goods will give us our gross profit. From that, we take away our operating expenses. Now, in this case, we have one line representing all of our indirect expenses. Operating expenses are those costs we incur to run the business that do not go directly into the product or service. Examples would be rent, salaries, insurance. We need all of those expenses to run our business, but they don't go directly into the product or service that we're creating. So from our gross profit, we subtract all of our operating expenses to give us what is called our operating profit. Now, many of you have heard the term EBITDA, which just means earnings before interest, tax, depreciation, and amortization. It's a long-standing term, really meaning the operating profit of the company. And why this particular line is important is everything above this line is controlled by management decisions. Everything below this line is really out of our control. So in other words, it's a way to measure, particularly if we're comparing this period to last period, how well the decisions that we have made are working out. So a lot of times, bankers, investors, others externally will look at that operating profit line to make a judgment as to how well management is making decisions. So from our operating profit line, we're going to subtract our non-cash deductions. And we'll go into this particular term a little bit later in the module, but it refers to accounting expenses that are not real expenses to us this year. And trust me on this, we'll get into this in a little more detail in just a few minutes. But these are separated out generally just for that reason. They are costs, but they're not costs in the real sense, only in an accounting sense. So we want to separate those out so they're very clear to anyone who's reading the financials. So from our operating profit, we subtract our non-cash deductions. That'll take our EBITDA down to EBIT, earnings before interest and tax. Interest obviously is the cost of the money we borrow, if we have borrowed any. Tax obviously refers to whatever taxes we may have to pay, and both of those are going to depend on external factors. If we have borrowed money, how much have we borrowed, and at what cost? There's your interest expense. Tax will depend on what country we're in, what industry we're in, how profitable we are. So those are both determined based on those external factors. So we have our earnings before interest and tax minus other. Now, other is one of those categories that sometimes confuses people. There is no reason for confusion. A simple explanation. Other refers to either a revenue or an expense that's not part of our normal business. If it was, it would be near the top. This is an example of a manufacturing company that sells a piece of equipment they no longer need for a gain. It would go in here. Or for a loss, for less than book value. It would go in here as other costs. In a service company, likewise, we are a service company and we sell a piece of equipment that we no longer need to run the business. That would be other. The reason it's put here is to separate our normal business, our ongoing revenue and expense, from the unusual occasional transactions that the reader of the financial is not going to expect to see time and again in the future. So that's why the particular location for other. Below other is our interest, which gives us our pre-tax profit. So there's profit again. If you look at the third line here, we have gross profit. Then we have operating profit as our fifth line. Now we have pre-tax profit. The wonderful world of accounting loves to confuse non-accountants. But if we take these in sequence, they should not be confusing for too long. So this is the income we have. This is the profit we have before we have to pay the required taxes. Once we subtract the taxes on the next line, we'll get to the true net income, which is also called the bottom line. Income statement is done. Except if we choose to pay out cash dividends. And this will vary tremendously by industry, by age of the company, by country. Some countries charge such a high tax for paying out cash dividends that they virtually never pay cash dividends. If a young company that is growing rapidly cannot afford to pay out cash dividends, they'll keep 100% of the net income in the company. So that's part of the explanation there. So once we get to our net income, we decide if we're going to pay any of that net income to our shareholders in a cash dividend or not, and if so, how much. And the difference between our net income and any cash dividends that are paid out go from the income statement here back to the equity section of the balance sheet, as we showed in the example, which we'll show again, as an increase to retained earnings. So this is one of the ways that we can see the link, one more link, between the income statement and the balance sheet. So net income minus any cash dividends gives us our addition to retained earnings. Because the key to remember here, at the end of each period, the net income we create, there's only two options for what we do with it. Either we pay it out in cash dividends, or we keep it in the company, there's your retained earnings, to finance the future growth of the organization. So that's the income statement, or the profit and loss.